So Matt Chambers from The Australian. We've continued to see iron ore prices fall this year, maybe the odd uptick, but the general trend has been downwards. Do we need to start dealing with this as reality and stop hoping that things will get better?
Well, probably in the longer term, yeah. I think just more and more supplies coming on from the big low-cost producers, and that's going to iron out in the medium term as lower prices. Interestingly enough, in the short, we've seemed to see prices sort of hit $80 and come up a little bit in the last week or so, and some seasonal factors there could actually see a little bit of a boost, but it doesn't look like that's going to be sustainable.
So just a quick bit of revision, what are the factors that have driven the cost down?
Well, the price is coming down because basically BHP and Rio and Fortescue are putting on a lot of low cost production. The prices have come off a lot quicker than anyone expected, and it sort of their accelerated production has coincided with a bit of a slowdown in China steel demand, so there's more iron ore on the market. And one other thing that we've seen is Chinese iron ore production has not come out of the market as quickly as expected. There was a view that high-cost Chinese production, once the price started coming down a little bit, if it was unprofitable, it would stop. But this month, probably, we've had both BHP and Rio note that a large portion of that is staying on because it's state-owned. And I guess there's a couple of reasons that China would do that. One is it wants to, it doesn't want to fire people, so it will keep people working a little bit longer if prices are low. The other is if it keeps putting iron ore onto the market, the price comes down, which is enormously beneficial for its big steel industry.
So in this environment, does that mean we're looking at a bit of a war of attrition, where big producers back their ability to just kind of take the pain and squeeze out smaller producers?
Yeah, well, I think so. And I think what is also becoming apparent is the extent to which the big producers are keen to do it, and that it is actually becoming a bit of a market share game. Rio came out recently and said, if we don't put this extra iron ore on the market, we're going to open the door for competitors to get in. And they named 30 projects around the world they thought would start up if they didn't expand. And once these guys are in, they will keep producing when the price sort of goes below their break-even investment level to their cash level, and maybe a bit below that. So I think what BHP and Rio are starting to articulate is that they don't want those guys coming into the market. And that is also bad news for anyone who's already in the market, because they've invested in these big projects thinking or hoping the iron ore price will be a lot more, and it looks like it'll be less.
So who are we talking about that are getting crunched here?
Most people outside of BHP and Rio, really. The smaller guys like Arium and Atlas are under a lot of pressure at the moment. But in recent weeks, we've also started to see Fortescue. There's a bit of a war of words between Fortescue Chief Nev Power and Rio Iron Ore Chief Andrew Harding last week, which shows that Fortescue's starting to feel the heat a bit. So what I think this extra Chinese production that has stayed in the market that people probably weren't thinking would, means that somewhere outside of China is going to have to make room for that. And that's actually, if BHP and Rio keep putting their low cost supply on, it's going to be people like Fortescue and potentially Brazil's Vale who start to feel quite a bit of pressure.
So what's actually going to happen to these companies that are becoming less profitable? Is this a buyout situation from a bigger company, or do they just shut down?
I guess that's the decisions they have to make. I mean, there's a couple of levels, pressure levels. I mean, the first one that will hit is the ability you have to pay back your debt. So your mine still might be making cash, but you can't pay your debt. So then, you have to work out what your options are there. And even then, I guess if the worst comes to worst and you go into administration, there might still be someone around who can run the thing at cash. So the mine doesn't necessarily shut down. But I mean, the most obvious thing that they have to do is lower costs. So that's going to be their first priority, is just, can we lower our costs at all to stay afloat?
And just finally, you obviously are well connected in the industry. I mean, are we seeing impacts beyond just the mining companies themselves, the towns, the support industries?
Yeah, we are starting to see a bit. I mean, obviously the contractors are, who do work around the mines are obviously starting to feel the pinch of this. Well, that's the general cost cutting. We saw Ausdrill, which is a drilling contractor from WA, come out and say that just the sentiment around iron ore meant customers don't need their drilling. And then the wider flow-on effect. I mean, you've got Colin Barnett, the WA Premier, has been making some wild claims and saying what the the iron ore miners are colluding, which he's recanted on. Basically, it's hit him because I think his government was factoring on iron ore prices of $120 a tonne, and now they're at 80. It means he's getting only 3/4 of the iron ore. Sorry, 2/3 of the iron ore money he was expecting.
Okay,
Yeah.
Matt Chambers, thanks very much.
Okay, thanks, Eric.